The views expressed in this podcast are those of the panelists and do not necessarily reflect the views of U.S. Money Reserve.
Welcome to America's Gold Authority podcast. Today I'm joined by 35th Director of the United States Mint and former Chief of Staff at the U.S. Treasury, Mr. Philip Deal. U.S. Money Reserve Director of Education, Brad Chastain. And also joining us today is one of our U.S. Money Reserve Sales Directors, Patrick Brunson. Today we'll be discussing the current global outlook and geopolitical and economic volatility. Welcome back, gentlemen. So let's talk about global economies here for a minute. Let's talk about the crisis going on. I'm going to shift over for some of these geopolitical concerns that people have, right? There's a lot of stuff going on around the world. I mean, Russia, Ukraine,
yes,
Israel, Hamas, China, but possibly Taiwan.
Yeah.
What are some of the things that I think we should be concerned about in terms of the geopolitical concerns and how they affect the markets? It's a broad topic, but we can get into the details here. We can get into the weeds, but let's talk a little bit about some of these concerns because people are watching the news and it's in front and center.
Well, take a look at the current rally in gold.
Okay.
Started October 7th.
Right.
You pinpoint it. And what happened October 7th? Hamas attacked Israel. And you can see that as of the opening of markets, after that day, this rally began. Now, it hit a little snag within the next month, in which the market for gold slipped a little bit. And then what's the next thing that happened? You can pinpoint this too. And that was the first consensus developed in the marketplace that the Fed was finally on top of inflation and was ready to start considering lowering interest rates. And gold took off again on that one. And then that sort of petered out for a while and you can see gold kind of slip a little bit and lay flat. But then as the war expanded through the Middle East and things intensified in Ukraine, and then eventually last year, for the first time since World War II, foreign troops were fighting on the soil of the Russian Republic, and tensions began to ramp up with China. Then gold had the biggest year in its history.
How much?
$600 an ounce or thereabout. Who's arguing? But it was this incredibly powerful response, and I think it outperformed the S&P and NASDAQ. I mean, in a strong year, we've talked about that before, and I think we're set for another year like that.
You think another $600 increase?
Well, at the beginning of the year, I said $3,000 an ounce.
And people thought you were crazy.
Well, they thought I said over $3,000 an ounce, and they thought I'd really climbed out there. And the mainstream, forecasters were saying, $2,800, $2,900 an ounce. Well, here we are 6 weeks into the year, and we're looking at $3,000 an ounce.
Right.
And I don't think, everybody's revising their estimates.
They always do.
Yeah, they always do.
They always do.
But I think we're going to have a year that surpasses the S&P 500 and NASDAQ. I don't know if we'll do $600 an ounce, but I mean,
do you think we
started the year at around
$3,300 is a possibility?
Oh, absolutely. I think we started the year at $2,600.
You're talking
we are
to people
already talking $400 at $3,000. So $600 is in sight. People ask me, "Am I too late?" That's the question I get asked most often. Look at what has happened over the last 14, 16 months. And I say, no, you're not too late.
No,
I mean, you may be too late if you're day trader in gold or but someone like us, the people who we're talking to, who are buying gold and holding it for the longer term as wealth insurance, no, it's not too late at all.
Yeah, speaking of not too late, you're talking to customers and you hear this from them, right? What are their thoughts in terms of getting into the market right now? Speaking of the geopolitical concerns, are they worried about how it's going to affect the price of gold? And where are they at? What's the mentality of the customer?
So It's a little bit of that. It has a lot to do with the value of the dollar and the goods and services they're buying on a daily basis. But typically, when gold prices are going up, that's not necessarily a good thing, because a lot of times that means other things are dropping.
Right.
And I think that's what a lot of the consumers are looking at is.
But let me stop you there for a minute. Why is that not a good thing? I mean, if I'm properly diversified and I'm mitigating risk, shouldn't I be happy that the price of gold is going up?
Yeah, if you're properly diversified, I would say yes. It's for the people who are not, because they could continuously get told they don't need to own it. That, they're, like we were talking about earlier, the bankers and the advisors shoot the idea down.
Right.
And it can create a negative connotation of, oh, I missed the boat. But people said the same thing 10 years ago.
Oh yeah.
When gold was at $1,200 or $1,300, man, I wish I would have gotten in at $400, $500, $600. I missed the boat. And I firmly believe, along with Philip, I'm sure that 10 years from now, people are going to say the same thing about today.
Right. You said something earlier about China. There's no way that the yuan would ever replace a dollar. They're soaring debt, right?
Right.
They have a real estate crisis, a collapse potentially, aging population.
Yep.
Are these the reasons why?
Yeah, they're among the reasons why. The Chinese economy is an opaque economy.
Yep.
I mean, there's not a lot of trust in the numbers that come out of China. The debt, the numbers you get on debt in China are just not credible whatsoever. Part of it is because they don't give you good statistics, but also because so much of the debt is carried by local governments. Debt in the United States, the debt is largely carried by the federal government, and it's there for all to see. And it's complicated in what you add and what you don't add, but for the most part, it's there to see. With the Chinese economy, there's tremendous debt burden underneath the surface.
Yeah.
So the Chinese economy, probably the debt load is 200% of GDP.
Well, I think I read something like 300%, wasn't it?
There are some estimates as high as 300%.
300%. That's crazy.
Yeah, it is crazy. And the other thing is that the aging population, and for the same reason in Europe, aging populations represent a huge burden, because there are fewer and fewer workers to carry the burden of an elderly, non-working population.
Right.
And we've seen the results. Japan was one of the earliest examples where we saw the results of an economy in which there was an aging population and slowing growth as a result of that. And I think China is really trapped in a very difficult situation in which the economy is teetering on the brink of deflation. They're really battling that. And you ask the question when you watch the Chinese leadership, why aren't you inflating the economy? There's this very intense debate by analysts going on about whether or not they understand the economics required in order to reinflate the economy, or whether or not the politics is such that they don't dare to do what's necessary to reinflate the economy. And I can't, it could be both. I mean, the way they handled the pandemic was a disaster. And both the handling of the pandemic and the handling of how to get out of the pandemic. I remember back in the 80s, everybody talked about how the Japanese were going to take over the world. Their economy was going to be the strongest. America would be left in the dirt. Same thing we're hearing, or have been hearing until recently, about the Chinese economy.
Right.
Now, all that's sort of good news, but economies that slip into recession, especially authoritarian economies that slip into recession, distract their populations by bellicose actions in the world. And we're seeing that with China in the South China Sea, their attitude toward Taiwan, the Philippines. It's not a good signal in terms of peace in the world.
No, speaking of peace in the world, Russia. Let's jump over to this topic real quick. Brad, they've been hit with sanctions. They've been hit with restricted trade. They've got a weakened currency, right? Where does Russia play into all of this?
Yeah, I mean, Russia as an economy isn't that large, relatively speaking.
Okay.
Right? So from
Smaller
just,
than California.
yeah,
Really?
Yes. Yeah.
Wow.
That's a good point. So from just that stance, not that big of a deal.
Okay.
What is obviously is with Europe and the reliance that they have had on energy over there. And it's really highlighted, I think, what we're seeing a lot throughout the globe in terms of this deglobalization or fragmentation, where countries are trying to become less reliant on global trade and more self-reliant in general. And we see that a lot, of course, within this administration coming in and what they're trying to accomplish, making the United States more resilient and protected from dependence foreign. So I think that's more than just the economic piece. It's more reflective of this sort of global shift to more self-reliance and being more cognizant about the risks of being dependent upon other countries.
Yeah. Thoughts?
So, in my opinion, I think that it's not necessarily about Russia itself. It's about the fact that they are help setting the stage to kind of divide the world in a sense from a financial standpoint. I know BRICS isn't going to take over the dollar and all that stuff, but it's going to basically be a global currency that can rival the dollar in a sense, especially if more countries choose to join the BRICS system to use whatever currency it is they're going to use whenever they actually implement it, if they actually do.
For somebody watching at home, what is BRICS? Just explain it real quick.
It's an acronym for Brazil, Russia, India, China, South Africa.
Okay.
And I want to say it was right around 2012 when the petrodollar expired. They created this system for these countries to use their own system to purchase goods and services from one another, as opposed to using the U.S. dollar.
Okay.
They specifically stated they want to be able to use their own local currencies between one, not a separate currency, but be able to use their own existing currencies that they use within their nations to trade back and forth.
Okay.
Which has proven not
Problematic.
effective.
Problematic.
So some speculate that they're going to back it with gold, but that just doesn't seem real. That may be one of the many assets that they back it with, but it's too soon to tell.
Is that why central banks in these countries are buying large amounts of gold, do you think?
Well, I think they're buying large amounts of gold for different reasons, different banks.
Okay.
I mean, the banks that have been most active that I'm aware of are, of course, China,
Right.
Poland,
Okay.
Turkey, and then there's some other Eastern Europeans. I don't know if there are any South American countries, but China has been the big one. And they were driving for an 18-month period until like May of last year. They were making huge purchases of gold with dollars.
They started ramping it back up again recently.
Well,
too.
they did, and then they took like a 6-month pause,
Yep.
and now they've bought for 3 months in a row.
Why?
The
Why'd
last
they pause?
Well, they're, good question. The Chinese don't tend to answer questions like that. We don't have podcasts in China in which government officials come out and explain themselves. But I think the general consensus was that they paused, expecting that their pause would lead to a fall in gold prices.
So they could buy more again.
So they could then come in and buy more. Well, that didn't happen. And so they've come back into the market. Now, some people argue, and I think there's a good argument to be said about this, that the Chinese are being driven by the U.S. sanction system. China has seen what the U.S. did to Russia, what the U.S. did to Iran. And because they have intentions to go after Taiwan, when they do that, they don't want to be subject to those kinds or as vulnerable to those kinds of pressures. I think there's some truth to that. But also what's happening, if you think in terms of your own personal finances, and oftentimes this is a bad idea to do this in international finance, but I think it's helpful. If you have an asset and you're reallocating the asset in your portfolio, and one asset has climbed in value to its peak and you're expecting it to fall, that's the asset you choose to sell to buy some other asset you think is going up in value. You've just described the dollar gold situation, where the dollar is near its peak. If I'm choosing an asset to sell, that's the one I'm going to sell. And gold is going to be what I buy. Because you don't buy other currencies. You're not buying the euro. You're not buying the rupee. You're not buying the yen. You're going to be buying gold.
Right.
So, and that's happening all over the world.
Sure.
Now with the Chinese, they have this enormous reserve of dollars. It swamps all their other reserves. Their gold reserves as a percentage of their total assets is like 4%. The average among sort of well-developed countries is probably 20%, around 20%. So if China were just to increase to 20% to that average, we're talking about a 5-fold increase in their holdings. It's an enormous sum of money that would transfer into the gold market. And I think that's one of the numbers that people have not really focused on. Where is China likely to go over the next 20 years with its gold holdings?
Right.
Most of that is going to come from dollars.
Right.
They don't want to tank the value of the dollar because they hold such enormous numbers.
would hurt them.
So they will sell, they'll hurt themselves. So they'll sell gradually over a period of time.
They're hedging.
And then buy gold. Not so much to hedge, although yes, that is a form of hedging like that, but because it just makes basic economic sense in managing a portfolio. And the central banks aren't traders. I mean, they're like us in a lot of cases. They're buying for the long term, buying and holding.
So talk about money for a minute here, because this is, people keep money in the banks. We got a banking crisis in this country. 1984, over 14,000 plus banks. Today, less than 5,000. A lot of it's through consolidation, right? Brad, what's going on?
Yeah, they've become too big to fail over that time through consolidation. So lots and lots of regulations. If you want to go start a bank, there's a lot of hoops to jump through. It's going to be a very difficult, tall order to accomplish, especially for smaller banks. And so through that process, we've seen large banks go in and buy smaller banks pretty consistently. So if you remember the too big to fail in 2008, where the financial crisis, as we've already talked about, happened, they came in and bailed them out as a result, because it would have created a much, much bigger issue.
So at what point don't they get bailed out?
That's another really good question. I mean, there's a lot of talk of, this is speculation from different articles that you can read, but there's a lot of speculation that a lot of the smaller regional banks, maybe the Treasury Department and the Federal Reserve don't need those banks to exist anymore. Maybe they can stick with the Big 12 to, essentially centralize the entire banking system. But as far as the FDIC, that's supposed to be the insurance for these banks. And it was made pretty clear in 2023, after Silicon Valley Bank went under, that they don't have the funding to insure all of our deposits. Now, they have credit lines that they can take from, essentially. But if we see a massive number of banks go under all at once, the question is how do you prevent all of them from going under at once? But more importantly, how do you prevent people from losing all their money? And that's one of the biggest fears at the consumer level right now when it comes to these banks, because they don't know that they can trust what they're being told.
Is that what you're hearing?
Yes, quite a bit. A lot of people don't believe in that FDIC placard on the counter at the bank anymore. And when they go in there to take just 20% of their money out of the bank to protect it in gold and put it in their safe where they feel safer,
right,
they're getting a lot of pushback from the bank, and that's giving them less confidence in those banks as well.
Right. Why do they get that pushback, though?
And one thing I'd say to your question about at what point don't they, it's when the banks don't really matter from a systemic area, systemic level. They'll let them fail or get bought into another bank.
Right.
The banks that matter on a systemic level, I'd argue there is no limit to what they will do. The consequences of not doing everything
Say that
are,
again?
I would say there is no limit to what the government, Federal Reserve, will not do to save the too big to fail banks, because the consequences are too disastrous. We're going to go to the dark ages if that were to happen. That, however, oddly enough, is wildly bullish for gold.
Right.
The actual collapse of the entire banking system is bad for everything, including gold, believe it or not. But the fact is, they're not going to let that happen. And the actions they take to do that, as we saw when they started rolling out quantitative easing in late 2008 and through 2009 and 13, gold went wild. Because the actions they take to save these is very, very, from that monetary standpoint we talked about, inflationary. It's putting lots of money, liquidity into the system, which gold responds to. So, but they're not going to let Chase
Do you disagree?
fail.
Well, I'm
so.
going to agree and disagree.
Okay,
I
let's hear
I think
it.
in a rational world.
First, tell me why you disagree.
No, I had to tell you why I agree first because
All
I
right.
disagree.
Go ahead.
I absolutely agree with Brad. In a rational world, you cannot allow these banks to fail. You absolutely cannot. It's one of the reasons why you don't let banks get this big. You don't want them to be in a situation where they're too big to fail.
But they're already
They're there. Yeah, we let it happen.
I mean,
In
it's
fact,
happened.
It happened because of deregulation that occurred back in the 1990s, and that was a bipartisan deal where we deregulated them, and we forgot all the lessons from the collapse in the 1930s and the Great Depression, and so. So I think in a rational world, I think Brad is absolutely right. In the real political world, I don't think he's right. I think it could go. And the reason is, for example, we will never pass through Congress, never in our lifetime, pass another TARP to bail out the banks. That will not happen again. And whether Democrats are in control or Republicans.
So you think we could see one of these big banks fail?
Well, yes, I do think we could see it. The Fed, I do believe the Fed, in a rational world, would do everything it could to prevent that, but the Fed doesn't have unlimited resources. You had to have fiscal resources brought to the table as well through TARP and through the deficit spending program that occurred in 2009. But the thing is, the Fed is ultimately a political organization.
Sure.
The people who make decisions at the Fed are appointed by the President of the United States. If the President of the United States doesn't want people who will save too big to fail banks, they won't be saved at the Fed. So I'm not at all confident that there won't be a day when the political will to save the banks doesn't exist. And part of what will be in that discussion is that the people who are willing to let them fail simply don't believe the consequences that will follow.
Okay.
They just don't believe it. And they'll think it's propaganda by the banks. I do believe it's a nightmare scenario to allow them to fail.
Do we live in a rational world, though?
We live in a political world.
How do we protect ourselves, Pat?
Well, that's why most consumers are turning to gold. I mean, at the end of the day, when you have something that you control and you're safe, or safety deposit box, whatever the case may be, it's not a digital asset anymore.
Sure.
I'm not talking about the dollar being a digital dollar, but it technically is it's a digital number in a computer system. They don't keep all your money in a vault in a box in the back of a bank anymore, right?
And the amount that exists is a very, very tiny fraction of the digital dollars that we all have in our bank.
Right.
Infinitesimally small.
Exactly. And with interest rates being so low for so long, and I know that interest rates are higher than what they've been for the last 10, 15 years, but I mean, you go back to the 80s, they were much higher, and that was much more normal, was 20, 22% interest rates. But we've gotten so addicted to low interest rates to continue to operate as a country that even 4 and 5% interest rates is too much for some people.
Right.
And it's because the assets that they're buying with those interest rates have gotten so inflated in price as well.
Yeah.
And so even just a small interest rate like 6 or 7%, which is still considered to be pretty big, relatively speaking, is a lot on a house that's,
Yeah.
800,000.
Ask somebody from the 80s if 6 and 7% is a high interest rate.
Right.
But going back to how do you protect yourself? You protect yourself by buying gold, right?
That's one option, yes.
Buying physical metal, right? And that's what you guys do. You guys do a great job of that. You help consumers protect their assets, convert cash into gold. Now, there's also another way. You can do it through an IRA.
Yep.
You can use tax-deferred dollars, right? You know these better than anybody. You can recite probably every available plan that is available to us, right? But 401ks, 457s, IRAs, annuities, well, qualified annuities. But there are ways to protect yourself inside this system, and gold is one of the best forms of protection and has stood the test of time. So if you're considering precious metals as part of your portfolio, give the men and women at U.S. Money Reserve a call. They have a wealth of knowledge, and they're standing by to answer any questions you have about how precious metals can help you in the good times and the bad. Once again, I'm Remy Castillo. Thank you for tuning in to another episode of America's Gold Authority podcast.
The markets for coins are unregulated. Prices can rise or fall and carry some risks. The company is not affiliated with the U.S. government or the U.S. Mint. Past performance of the coin or the market cannot predict future performance. All calls recorded for quality assurance. Offer void where prohibited.